Well, headlining today, BHP Billiton has agreed to a settlement with the Brazilian government over the Samarco dam disaster worth at least $2.5 billion. The Australian miner and its joint venture partner Vale say the compensation will be paid to a government fund over the next 5 years. An initial $1.5 billion will be paid until 2018, with smaller annual sums of at least $282 million to follow in each of the next 3 years. BHP says the term of the agreement is 15 years, renewable for periods of 1 year until its obligations have been met. It comes after the November dam collapse at the Samarco mine killed at least 17 people in what's been named Brazil's worst environmental disaster. Vale shares, they soared 10% on the news offshore. And BHP Billiton shares are doing well today, up by about 3%. Not all outperforming the major material plays by too much, though. Let's get over to Chris Conway now from the Australian Stock Report. He joins us live from Melbourne. And Chris, looking at the market reaction today, you'd have to say that the BHP damage bill really came in away probably from the top end of expectations.
Good afternoon, Kate. Yes, look, it certainly did. I think there were some estimates that the bill to BHP would be circa $4 to $5 billion. Obviously, at $2.5 billion, it's significantly below those higher estimates. But more importantly, the number has now been quantified, and you know the importance of that is that it allows traders, analysts, investors to feed those numbers into their models, and it removes that uncertainty and it creates certainty around what BHP's obligations will be moving forward. So, like you said, obviously why we saw Vale up 10% overnight, and why we are seeing a nice pop in BHP shares today.
What rating do you have on the stock at the moment?
We are probably more neutral now. We were buyers down towards the $14 level. We're still in a trade for our trading clients. Our target is circa $20, $22. But now that it has obviously run off those lows, yeah, we'd probably be neutral. I don't think we'd be putting any clients into it now. But yeah, still slightly more bullish than bearish.
All right, let's move on now. You're also pretty sceptical at the moment about the recent rally we've seen on the broader index. You put it mostly down to short covering, and indeed we have seen some of those trades unwind. Do you think we're in store for more weakness soon?
Again, I'm probably a neutral at the moment, Kate. I think the tipping point for the Aussie market on the XJO, if people need a number to pin where the market could be headed on, is 50.70. That was the swing high from early February. If we can clear that level and clear it in a meaningful way, then it opens up a pathway up into 53 or 5400, which of course was the cap towards the end of last year. But yeah, look, as you say, the rally recently has been, I think, largely on short covering. It was only last week that we were seeing a lot of offshore selling and the top 20 names getting beaten up very, very badly. So a bit of short covering and a few better than expected data prints a rally does not make, in my opinion. So neutral at the moment, and very much waiting to see how the market reacts around that 50.70 level. I think what it will take for us to push higher is further gains in the US. If the S&P 500 can clear the 2000 level, then that would obviously see the Aussie market rally in behind it. And that of course all depends on what the US Federal Reserve does regarding interest rate decisions. So in a roundabout sort of way, we tie it all back to what's going to happen with the US Federal Reserve and how quickly or otherwise they will want to raise interest rates.
Could you just explain that connection for us, just crystallise it, what the Fed does and how that's going to impact our market?
Yeah, well, look, I mean, obviously, if the economy is not strong enough in the US and the Fed refrains from raising interest rates, that will send a signal to the market and to investors that the US economy is not performing as well as it should be. Now, the other edge of that knife is that it will mean that money remains cheap, and generally that has been a good thing for equity markets. So that's one side of the coin. The other side of the coin is that the US economy continues to print better than expected economic data, and the Fed says, well, the economy is healthy enough to raise interest rates, and that should be a signal that the economy obviously is performing well, and companies should do well out of the economy being better than expected. But the downside of that, of course, is that money becomes more expensive, and there's less likely to be flows into equity markets. So It's a very finely balanced equation, and that is why, of course, the Fed has been trying to play a very straight bat recently with regards to its policy announcements. But what it will mean for us locally, whichever way it goes, will be what happens with the US equity market. If the US equity market continues to rally, like I said, above 2,000 on the S&P 500, that opens up a pathway again into the all-time highs around 2140, I think it is, and that should see our market locally clear that 5070 hurdle that I've been talking about, and at least allow us, I think, to get back to the 5400 cap that we saw towards the end of last year.
Now that we have a little distance from reporting season and we can stand back and reflect, what do you think of it?
Look, I think it was better than expected, and I think that's part of the reason why we're seeing equities rally, is that reporting season wasn't as bad as everyone maybe anticipated it would be. On an earnings per share level, I think 44% of companies managed to beat estimates. So overall, a solid set of results, and it's really reflective of what's going on in the Australian economy, and some of the positive numbers that we've seen over the past couple of days is that, you know, we are very fortunate that Australia has quite a robust economy relative to what's going on in the rest of the world, and the companies that are operating here, if they're nimble and they run lean, can do particularly well and can print good profit results, which is what we've seen.
Let's move on to what you're long at the moment. CSL, we've seen it pull back recently. It's closer to 100 now. Do you see value here?
Yeah, look, we like CSL. We thought their numbers were pretty good during reporting season, and as you say, it really is the pullback towards the $100 level that has made it more attractive. We're targeting a move into 115, so we like it. Probably more a short-term trade than a long-term investment, but we're happy to be in it at the moment.
And Qantas, you're also not worried about a rising fuel price?
Look, the rising fuel price will create volatility for Qantas in the short term, but again, a really strong set of numbers from Qantas. Their turnaround story is well along the road and doing particularly well. It is now a well-run business that should be consistently profitable. So absolutely, the oil price or a potentially rising oil price will impact on Qantas, but we think they've done enough work to overcome that. And the medium-term target on that one is $4.50. We were surprised to see it beaten up so badly on the day that it reported. I think it was down 6 or 7%. Again, that was probably due to oil prices being higher the night before. The following night, oil prices dropped, and the next day after Qantas reported, it made back all of those losses from the previous session. But fundamentally now we think it's a pretty well-run company, like I said.
And the final one, JB HiFi at the moment, you like the look of this, even though we could have a Dick Smith fire sale for the next few weeks?
Yeah, well, undoubtedly the stock that Dick Smith has to dump might have a negative impact on JB and indeed Harvey Norman in the short term, but at the end of the day, it's old stock that no one really wanted in the first place, hence why Dick Smith got itself in trouble. And once that is cleared, ultimately it means that there's one less competitor in the space, and moving into those end of financial year sales, we expect JB HiFi and indeed Harvey Norman to do particularly well.
All right, Chris, thanks so much for joining us. We really appreciate it.
Thanks, Kate.
Chris Conway from the Australian Stock Report joining us there from Melbourne.